Are you wondering how to bridge the financial gap for college after exhausting federal student aid options? It is a common concern for many students and families who are determined to secure their educational future. Understanding the scope of private student loans can be a crucial step in your financial planning. When it comes to private student loans, the maximum amount you can borrow is typically much higher than federal loan limits. In most cases, private lenders allow you to borrow up to the full certified cost of attendance at your school, minus any other financial aid you receive. This means they are designed to cover whatever remaining educational expenses you have. The reason for these higher limits lies in how private loans operate compared to federal ones. Private lenders are financial institutions that assess your creditworthiness or that of a cosigner before approving a loan. They factor in your credit score, income, and debt-to-income ratio to determine your borrowing capacity. This individualized assessment, combined with the educational institution's determined cost of attendance, allows for more flexible and often higher loan amounts than the standardized limits set for federal loans. Your school's cost of attendance, often referred to as COA, is a comprehensive figure. It includes not just tuition and fees, but also estimates for living expenses like room and board, books, supplies, transportation costs, and even personal expenses. Lenders relying on this official COA figure provided by your institution to ensure you do not borrow more than what is legitimately needed to cover your education. To determine your specific maximum private loan eligibility, you will first need to know your school's official cost of attendance for the academic year. Then, subtract any grants, scholarships, or federal loans you have already received. The remaining amount is generally the maximum you can request from a private lender. Remember, lenders will also perform their own credit evaluation to finalize the amount they are willing to offer. An important distinction to be aware of is the concept of aggregation. Unlike federal loans, which often have lifetime borrowing maximums across multiple loans, private lenders usually do not have a universal aggregate limit. Instead, they evaluate your ability to repay each specific loan based on your current financial standing. This means your eligibility can change with each application, reflecting your financial health at that time. Understanding that private student loans can cover the full cost of attendance, as certified by your school, provides significant flexibility for financing your education. However, it also emphasizes the importance of borrowing responsibly and only taking out what you truly need. Always prioritize federal loans first due to their generally more favorable terms, and then strategically use private loans to cover any remaining expenses. This approach ensures you have the necessary funds for your studies while managing your future financial obligations wisely.